was the miners today. The banks did well. A bit of a mixed picture coming through in some other areas with CSL losing a bit of ground throughout the day today, but all things considered, nothing to complain about. Let's see if these guys have some complaints. Welcome, Todd Warren from Tribeca Investment Partners, Trent Primmer from Barclays Capital, and Alex Pikulis from Harper's Bernays. Cheers to the week that was.
Cheers to Friday.
Yeah. We didn't mention in and amongst all of that, there were a lot of quarterly reports coming out, production reports, Rio Tinto's results. Was it a good week for you?
Yeah, well, Rio was an interesting one, right? That was probably the big one of the week. And actually probably was the biggest disappointment for many because of their capital management was not what the market expected. Numbers themselves are actually okay, but when you're making as much money as you are and you've got a net cash balance sheet, paying out a 50% dividend yield is a bit
and
light
no
on.
Special divvy.
No
yeah.
special.
Look, we'll get into companies a little bit later, but I think that reminded me of Macquarie. So is that just Rio being cautious like Macquarie said it's going to be going forward because of the whole macro environment?
I think the macro environment's certainly uncertain at the moment, and we're seeing macro data, roll off a cliff, and that's why you've seen interest rates. 10-year bond yields have gone from in Australia, 3.7 or so % a month ago to 3 today. So there's been a big change in the market environment over the last month or two, I would argue. Economic data in the US has been disappointing since May. So interest rates coming off has seen a bunch of short squeezes happening in some of that unprofitable tech space in the last couple of weeks. So the macro moves in the last couple of weeks are really, really big.
Yeah, Trent, we were just talking about 6% up for the month on the local index. Is that sustainable? Investors, have markets got ahead of themselves, do you feel?
$1 million question.
Yeah.
Well, like Alex said, it's difficult to navigate, and I think like these times we haven't seen anything like this. All the geopolitical tensions, the incredible amount of inflation, supply chain issues, COVID, which is arguably, you could class it as a natural disaster really that's squeezing economies globally. So I suppose when markets rebound, and particularly starting with tech-heavy names that are obviously more volatile, the Nasdaq index I think bounced 4% odd. It's easy to put the optimistic hat on and start investing in some of these names, but I'd be cautious. I still think there's more downside to come, and inflation really hasn't reached its peak. You ideally want to see more movements from the RBA to start increasing those rates, probably another 75 basis points, I'd say, to sort of combat that high inflation. But look, they were pretty late to the party originally, so
it's an interesting
I'm not
one
optimistic.
though, right? Because we've had CPI data out locally this week. We've had the Fed this week. CPI data in the US actually, a week or two ago, and even though it surprised on the upside, the market didn't care because the market's sort of now looking at all the more immediate data, which is rolling over, and saying, well, this backward-looking inflation data that's still pretty high, not sure about it going forward. Maybe we're going to see it roll over at some point. The Australian data that came out this week, it's quarterly to the end of June. What happened in April and May is a long, long time ago now.
So beyond that economic data, is that mean earnings season is going to be critical? So we're seeing that out of the States at the moment, the picture that is painting. What are you expecting it's going to really paint the picture here once we start getting more of those earnings coming through locally?
But those are backward looking as well, arguably.
Well, no, that's right. And that's what I was about to say.
Hopefully some guidance coming with it.
We'll look at MasterCard, what they're saying, what Bank of America's saying, what JP Morgan is saying. They're all saying, wow, the consumer's still great. And the consumer's still spending. But the market's a forward-looking beast, and the market is looking at housing rolling over in the US and thinking, okay, the consumer's still spending today, but are they going to be spending in 6 months' time? And there are big changes in thinking of what the market's starting to price in looking forward versus what we've just seen in the last, whether it's 3 months or 6 months. So I think the proof will be in the pudding, but at the moment the market's really starting to price the economy's going to slow here. The US has just printed another negative GDP print, so technical recession, we can put that to one side. I don't think that matters that much. It's whether or not unemployment's going to go up and how much the consumer's going to slow, but that's what the market is starting to think a lot about and starting to price in.
What's your view, Todd? Because I know you follow energy markets very, very closely. We've watched the price of gas in the States coming down. There's expectations that it will fall further. What's your view on the economy, the macro environment, and how that's focusing your mind for investing?
Yeah, well, certainly you've seen, I mean, there's that fear that we get, a recession play out. What you're also seeing, though, is the market telling you that they already are they expect that to come. We've seen copper prices roll over. I mean, oil apparently is going to bear market at $100 a barrel. Go figure. But I think most of these companies that are producing oil will be pretty happy right now. Obviously, there is a wild card in terms of the broader macro piece, certainly with regards to Russia, Ukraine, etc. But what we're certainly seeing in the resources patch is that the market's very much focused on demand and focusing very little on supply. And that's the bit that I think the market's missing. We've seen constant disappointment on the supply side. And indeed, looking out over the next 12 months, coming back to Andrew's question about guidance, we've seen 500,000 tonnes just from a handful of companies in the copper market supply come out. That would take out, pretty much your bear case with regards to demand destruction. So, what's priced in a fear trade? We don't know how do you price fear, but there's a considerable amount of fear that's already priced, and I mean, oil, copper, whatever, obviously different supply demand scenarios, but broadly speaking, we think the oil market at $100 a barrel still feels pretty good, and the market's got its hopes way too high on supply.
And Andrew, can I ask? I mean, people refer to copper as Dr. Copper from an economic perspective. Being the materials expert, the copper price is elevated on a longer term view, but it's come off a reasonable amount. Do these levels reflect an assumption that the economy is going to slow a lot, or do you think there's still downside in copper?
Well, I think there is a significant reflection already. Yeah, I mean, and so the point is, we've had copper trade above $4 a pound now for a couple of years, and the bears will point to but you've got, and I can point to about 1 million tonnes of supply coming from new mines that'll be commissioned in the next 18 months. But the problem is, if we want to go down the path of decarbonisation, we're going to need an absolute truckload more copper that we haven't even started to contemplate in terms of new mines being built. So if these mines weren't being commissioned or committed to at $4 copper, they're not going to be committed to a $3 copper. So, and to be fair, the capital markets have told these mining companies, whatever you do, don't put your money in the ground. So pay a dividend, buy back your stock, pay down your debt. Which comes back to the point about Rio Tinto.
Except if your name is Rio.
This is the disappointment, right?
It's incredible as well. Not a lot of people understand how much of that material is actually used in some of this emerging, renewable energy thematic, all these new technology. Like even in your electric vehicles, it's something like 40 kilos of copper wiring in the average vehicle.
4 times as much as an ICE, right?
Yeah, exactly. So, internal combustion. It's crazy. So. Yeah, I don't think the market's caught up on it.
And that's exactly it. So, based on...
Because we've been dazzled by lithium, we should actually be focusing on
copper.
Sure.
Do you think copper names, I mean, if you don't want to get stock specific, are copper names generally cheap?
I'd say so. Obviously on the small cap end, like a lot of money's been wiped out of that small cap market. You got some of the companies which are probably a bit disappointing now. You've got the recent dual TSX listed Hot Chili with its Chilean operations, and I think they're 250 million tonnes or something away from a tier 1 resource, is it? Or? But they've halved in value. Correct. They're still cheap.
We heard from Ausbiz Minerals, didn't we, this week? Yeah, that was this week. It's all a bit of a blur. Sometimes on a Friday.
Yeah, it was earlier this week. So I mean, that's another supply disappointment potentially. They've got their big growth project is obviously Carapacena coming up to nameplate, and then the growth project West Musgrave they'll probably delay that just on the basis of their balance sheet. So,
So just in terms of production, obviously all these miners struggling at the moment. Obviously labour costs, those costs are rising in general, and we've seen that particularly with the gold miners as well. So is that playing out and going to continue to play out across the sector, do you feel?
I do. Yeah. You're seeing, broadly speaking, cost inflation of 15-20%. Broadly across the board. So yeah, they're feeling it. Obviously, labour is the big one, and fuel. So some of the labour issues we've probably seen the worst of, in terms of labour availability. It just takes time to work our way out of that. So
I think we've taken this to a very big picture sort of conversation all of a sudden. Alex, so on everything we've spoken about, we had a lot of the reports coming through this week. We had Macquarie this week. We're not going to talk about buy now, pay later, should we? No, let's not.
Well, let's just quickly go there.
We should probably touch on it.
Yeah, because I mean, obviously seen those significant price moves too with Zip,
Huge.
Sezzle,
Yeah.
goodness.
Sezzle was 20.
Sezzle, aren't you?
Sezzle was 20 cents a week ago. It opened this morning at $1.40, and it's $1 now.
Yeah.
So no, I'm not piling money in. and how you can trade that, I have no idea. So good luck to the people who have. But to be honest, I think when you get massive price caps, and I've spent a long time of my career dealing with hedge funds around the world, trading Aussie equities. When you get big price gaps like that, it's more often than not people losing money rather than making money. And I think what you're seeing in a bunch of those stocks is a short squeeze.
Right.
Sezzle 20 cents to $1.40 this morning. Zip's not quite as much, but a similar rally. And Zip this morning was up 15%. Now it's down 20 this afternoon. So some huge moves, but I think that's more people losing money, unfortunately, rather than making money.
Okay, so let's assume you're staying away from the buy now, pay later sector. Are you staying away from retailers, given all we've spoken about as well? Like, are you particularly nervous about consumer discretionary, or are you attracted to consumer staples? Or nothing of the above?
So for us, neither of those two, but we are quite cautious about consumer discretionary. We're quite cautious about the consumer outlook over the next, 12 to 24 months. With the sell-off that we had seen, we started increasing a little bit of exposure to some housing-related, like James Hardie, so more US than Australia, just because we thought they were oversold, and we thought that some of the interest rate increases that we'd seen would actually cool down a little bit, which we have seen. So we've dipped our toe in some of those sorts of things, a month or so ago, but we're staying pretty clear of the consumer, and we've just, from the staples perspective, we've just found them hard because as much as they're defensive, and we think you want to play a bit defensive at the moment, the staples are incredibly expensive. You've got Woolworths trading at, I haven't looked at it lately, but a month ago it was 28 times earnings. For a business that's not growing by much, I'm not that interested in paying 28 times earnings for that. So we're not in either of those spaces at the moment. Yeah.
Trent, what sectors are you finding attractive at the moment?
Well, we had this chat before, briefly before we came on the show, but I think around earnings season we're probably going to look at, obviously various sectors, but companies that look cheap, companies with relatively good outlook statements, but not blue sky or fluffy outlook statements, companies that look reasonably cheap, and then we'll look at throwing some capital into these companies and building out some portfolios long term if they're cheap enough.
What's
there's
your cash
nothing-
level at the moment?
We're sitting at about 30-40%.
Oh, wow.
Yeah, which we have for quite some time. We've held gold names, but obviously gold hasn't been doing much. So
Sorry, Trent.
I know. I come on the show every time, and the gold price goes down more.
That's confounding, though, isn't it? Really,
It's crazy.
Yeah.
And this is the thing that we spoke about before. This isn't a market that you can pick easily, and I think it'll be a good case study for future markets. Like you'll see what we're going through right now in economic and commerce textbooks, ages. But it is a very difficult market to pick, and when nothing particularly stands out to you, I think it's better to err on the side of caution and hold some cash behind you and just wait to deploy it appropriately. I think patience is a big thing in this market, and earnings season will give us a good idea of where these companies are heading. In saying that, the sectors I'd look at, still like gold. As much as it pains me to say that, probably gold. Look, energy, definitely. A lot of these good, unlisted renewable energy companies look quite good, quite attractive. Some with healthy balance sheets, some producing, even in the hydrogen space. But even that, capital markets, I'd be wary of parking money in some of these names.
Are you chomping at the bit to get active, or is patience a virtue right now in your sort of area of the market as well?
Yeah, we are nibbling. Like, I don't think it's. I don't think.
I think we invented that term, didn't we?
Oh, sorry.
Yeah.
Sorry. That's right. Yeah. Well, always cautious to use the term, averaging down, because it implies you got your first decision wrong.
Right.
But yeah, look, there are areas where, as Trent says, there are some companies out there that are bulletproof balance sheets, making money hand over fist, and based on what we can tell, in the resources sector at least, that are trading. Some of them trading at the dips we saw, in the previous dips of the downturns of early 16, or even back to 08, GFC type. So that doesn't make sense when you've got these balance sheets that are so healthy.
Name one. That's on behalf of the viewers.
Well, I can tell you that the world's largest copper producer, Freeport, is exactly that.
Okay, cool.
So and these guys.
You're welcome.
They had a 7 times geared balance sheet at the start of 2016. Today they're pretty much free, net cash. So for us, that's where you start nibbling away.
Okay, give us a local copper producer then.
Or gold. Do you like gold? Or I'd love to see a little bit of a bar brawl happening here.
Copper gold.
Yeah, well, okay. A little story. I did see a meme circulating the other day, and it was a trader's guide to gold, and it said, if yields go up, bad. If yields go down, bad. Inflation up, bad. Inflation down, bad. Bad. So to your point,
there's no good market for it, really.
So the non-consensual investor in me says maybe that's the opportunity.
Yeah.
We in the gold space, we still like Northern Star. It actually, of the gold guys, could potentially do some capital management. It's got the opportunity to pay out a dividend or buy back some stock. And maybe even grow a little bit, although they seem to have stepped back a little bit from their growth plans. In the local copper space, it's a more challenging question. I like, Oz is a good go-to. It's a reasonably safe bet in the Australian marketplace. But yeah, as I touched on earlier, there's maybe some question marks around their commitment to some of their longer-term growth projects.
Alex, if you've known me long enough, you would know that it's only fair if I ask you what you would potentially buy. I mean, or strategically, are you waiting till after reporting season to get fluffy guidance statements or lack of guidance statement out of the way?
Actually, just before you do that, you did gasp when you said, when Trent revealed he was holding 30% cash. What are you holding?
No, we're holding a reasonable amount of cash actually as well. So I think holding cash is a perfectly valid investment decision. If you think there's going to be better opportunities coming along, then you should sit on a bit of cash. So we're towards 15%. We'd find it difficult to have as much as 30.
Yeah.
Not that that's written into a mandate anywhere, but to be sitting on that much cash, our clients are expecting us to deploy it for them. So, but yeah, we're around 15, just under. Nadine, to your question, I mean, we've really been sifting through for oversold growth names. That's been the same thematic I've talked about for the last couple of months, and we're still very much on that tack. So I've talked about Zero on the program before. It's a name that we really like, and we'd probably like to buy more of it at some point. We bought it initially at 77. If it came back to 77, we'd probably double our position.
Really?
James Hardie we've bought recently as well. Reliance we've added quite recently. I mentioned the US housing exposure before.
Despite what's going on in the US at the moment, we're seeing the housing market coming off.
Yeah, but I guess we just thought that some of those names were oversold and the sentiment towards US housing. So if you look at housing starts over a long-term view on the US, we've only just got back from an incredible underbuild post the GFC to what is a more sustainable level of building in the US. It's not some bubble like pre-GFC type level. It's just the sustainable, demand-driven level of housing construction that we're at in the US. So from a longer-term perspective, we don't see risk at the moment to the level of housing construction in the US. Of course, rising interest rates is a headwind to that, but we think the stock started to reflect real risk to that number going forward, and we don't think there is a risk to that number. We think it's just a short-term adjustment to the interest rate environment, and the outlook statements are undoubtedly going to weaken from the home building sector in the US, but it got to a point where we thought all of that was well and truly reflected, and the medium-term outlook was better. So that was the thesis.